All right, today we're going to try and make sense of the very, very confusing situation over at Plug Power. They just dropped their latest earnings report, and honestly, it's a real head scratcher. You've got some fantastic news on one side, but then you look at the stock and it's taking a hit. So let's dig in and figure out what on earth is going on.
And this is the core question we're tackling today. This is the big puzzle. Plug Power just did something that investors have been waiting on for years. So why then did the market basically give it a thumbs down? Let's get to the bottom of this. You know, this quote from their new CEO, Jose Luis Crespo, it really captures the good side of the story. He's celebrating a huge operational win, and he's right to do so. But behind all the celebrating, the stock has been under some serious pressure. The market is clearly not convinced, and that's the disconnect we need to explore. So yeah, let's break down this confusing victory. How can a company possibly have its best quarter in years and still leave investors feeling so nervous? Well, as always, the answer is hiding in the details. Okay, so the headline news was undeniably positive. I mean, for a really long time, Plug has basically been losing money on every single sale it made. So to finally post a positive gross margin, even a small one, is a really big deal. It hints that maybe, just maybe, a real turnaround could be happening. The number itself is 2.4%. Now, that might not sound huge, but you have to look at where they came from. In the same quarter last year, their gross margin was a jaw-dropping negative 122.5%. That is a 125 percentage point swing in just 1 year. It's an incredible turnaround, and it's all thanks to their big cost-cutting program they call Project Quantum Leap. So you see that massive improvement, and you think, great, the stock's gonna soar, right? Well, nope. Despite this huge step forward, the market's first reaction was to sell, pushing the stock down over 4%. Clearly, investors saw the good news, but something else in that report really spooked them. And this brings us right to the financial tug-of-war that's going on here. The earnings report tells two completely different stories at the same time. One is a story of great operational progress, but the other, it's a story of some massive and frankly scary accounting charges. Let's break them both down. All right, let's start with the bright side. The story that the company's management really wants investors to focus on. It's a story of impressive growth and becoming a much more efficient company. I mean, you can see the progress right here in black and white. Revenue is up more than 17% from last year, and it beat what analysts were expecting. The gross margin, like we said, made that monster leap into positive territory. And just look at the adjusted earnings per share, or EPS. The loss shrank like crazy, from 29 cents a share all the way down to just 6 cents. On all these key operational numbers, it was a home run. But that word adjusted in front of EPS, that is a very important word. And that's exactly where the bad news comes storming in. The official unadjusted numbers, they paint a much darker picture. This is the real kicker. See, Wall Street was forecasting a loss of about 10 cents per share. On that adjusted non-GAAP number, Plug blew past that, only losing 6 cents. A beat, but on the official, by-the-books, GAAP-reported number, the loss was a staggering 63 cents per share. This wasn't just a miss, it was a gigantic miss that took everyone by complete surprise. So what in the world caused that huge loss? Well, here it is. A $763 million non-cash asset impairment charge. Now, in simple terms, that means the company had to officially admit that some of its assets and investments it made in the past, well, they just weren't worth what they'd been claiming. And even though it's a non-cash charge, it is a major red flag for investors about the quality of past decisions. And all of this financial complexity, it's all happening while the company is facing some major strategic risks. But it also has some incredible strengths, especially its list of clients. This company is truly balanced on a knife's edge between enormous potential and some very significant danger. This chart really shows the high-stakes battle they're in. On one side, you have their internal turnaround plan. They're cutting costs with Project Quantum Leap, they're selling off assets to raise cash, like that big deal with Stream Data Centers, and they just brought in a new CEO. But on the other side, man, a storm is gathering. A crucial $1.66 billion government loan is on hold, shareholders just approved a move that could seriously water down existing shares, and there's a class action lawsuit looming. And this timeline just shows you how fast everything has been moving. The last few months have been an absolute whirlwind of activity, from putting the brakes on that DOE loan to selling off big assets and changing the CEO. This is a company in a very rapid and potentially very painful transition. So with all of this risk, you have to ask, why are investors still paying attention at all? Why hasn't the stock completely collapsed? Well, because buried under all those challenges, Plug Power has a very powerful competitive advantage, what you might call an economic moat that's pretty hard to ignore. Look at this list. These are not just any customers. These are some of the biggest, most powerful corporations on the planet. Plug has deployed over 72,000 of its fuel cell systems, mostly for forklifts, in the gigantic warehouses of companies like Amazon and Walmart. These deep, long-standing relationships, they are the company's crown jewels. They are the core of any argument for its long-term survival and success. So you put it all together, the operational wins, the accounting bombshells, the huge risks, and those blue-chip clients, and you have to wonder, what does the future actually hold? Well, we can see three pretty distinct paths forward for Plug Power from here. First, you've got the bull case. This is the optimistic view, where the margin improvements are real and they stick around. The asset sales give them enough cash to get to profitability, and they actually hit their goals. Then you have the bear case, the nightmare scenario. Cash burn gets out of control, the DOE loan is officially canceled, and the company is forced to issue tons of new stock just to keep the lights on. And finally, you have the base case, sort of a muddle-through scenario. The company survives, but it struggles, lurching from one crisis to the next, and the stock stays super volatile for years. And this shows what the analysts on Wall Street think, and, well, it lines up pretty heavily with that middle path. The huge majority of analysts have a hold rating on the stock. It's not a strong buy, it's not a strong sell, it is a collective we don't know, let's wait and see, which just perfectly captures the massive uncertainty around this company right now. You know, this classic quote from Benjamin Graham perfectly sums up the entire situation. Right now, the market is a voting machine, and it just voted no on that massive accounting loss and all the risks on the horizon. But in the long run, it's going to become a weighing machine. It will weigh the company's actual sustained performance and its ability to generate cash. The final verdict on Plug Power really depends on which machine has it right. And that leaves us with a final, all-important question. Was this last quarter's positive gross margin the beginning of a real, historic turning point for Plug Power? Or was it just a brief, sunny moment in a much longer and still very, very uncertain struggle for survival? That right there is the billion-dollar question that investors now have to answer.